Hey, Dale, can you hear me?
Michael, welcome back. How are you, buddy? I can hear you. Can you hear me?
Yes, sir.
Welcome back, Michael. Great to have you back, and a great time to be talking to you. I caught a tweet that you did, I don't know, about 2 weeks ago. You wrote a piece on how a strong dollar is counterproductive to the Fed. It works against what they're trying to accomplish, and the dollar index making new highs coming in here today. Can you explain to our community how this would be different than almost any other country that's in the currency war to depreciate? Is it similar in what Draghi's trying to accomplish right now?
Yeah, let's first talk about why inflation and deflation matters for currency movement, just to kind of give some backdrop there. When you have a depreciating currency, that tends to be the equivalent of importing inflation to a country. Why? Because the weaker currency makes imported goods more expensive, makes exported goods cheaper, right? And a stronger currency does the opposite. Now, in a world where developed equities, developed markets, developed economies are faced with significant deflationary pressure, it seems like the only way to try and counter that deflation is to import inflation and to export that deflation. The way that's done is with a weaker currency. Now, we've seen the effect of that clearly with the Japanese yen. Abenomics and Kuroda and all the like have basically tried to target a weaker yen to create inflation in Japan. That caused the dollar, obviously, to rise. And then in the case of the European Central Bank, it seems like the real reason to do this negative deposit rate is ultimately to target a weaker euro, to try and get inflation into Europe's, the EU's economic foray, so to speak. Now,
Michael,
if that's the case,
is there a dramatic time lag when the currencies depreciate? Because let's face it, Draghi was successful from the 140 area. We've taken the euro down 900 pips since then, and they're still not getting the numbers they need.
Yeah, and that maybe is why we could see at some point the euro hit parity to the dollar, maybe sooner than we think. But the problem for the Fed, it's not just a function of what happens in Europe is isolated to just Europe. If they're targeting a lower euro, because nothing else seems to be working to force inflation in the Eurozone, that's going to be deflationary for the United States. And we already have a lack of inflation here in the U.S. when you look at the velocity of money and when you look at inflation expectations. So on the one hand, you have this feeling that the Fed's going to raise rates soon after they end their quantitative easing. But by the same token, if the dollar is going to keep appreciating because the euro is going to be weaker because of what the ECB is doing, that's further deflationary pressure. It's hard to see how the Fed can raise rates if you're going to have a stronger dollar when you already don't have the inflation that they're hoping for.
Right, okay. So what's behind this overnight weakness in the Treasury market, Michael? I've been dumbfounded. I thought TLTs were going to top around 116, 117 because of the weakness in the yen and the strength in U.S. dollar yen. And that correlation broke down until today with the strength in the yen. Treasuries are taking it on the chin. To me, it looks like this kind of gap down could leave an island top in the Treasuries. And people are as bullish Treasuries now as they were bearish coming into the beginning of the year. What's your take on that, and is that part of the dollar equation?
I think there is a link there, but it's hard to, let's keep in mind, every time we hear this mantra of buy the dip in equities, this has been buy the dip in treasuries in 2014. You've seen actually a lot of buying for every type of yield movement higher, ultimately to only go lower. So it seems actually that I'm a little bit hesitant to say that you're going to see a breakdown here in treasuries. Keep in mind in the case of treasury ETFs, a lot of them go ex-dividend. And also at the start of the month, which is when today is obviously.
How about the yields are rising from the high yield we had at the end of the year down to 2.3. Couldn't the treasuries retrace to 2 3/4 and still be a buy at that point instead of here?
Yeah, it depends very much on where inflation is. GAFCAL research, I referenced this in my last week in review, shows that global inflation is basically at 56-month lows. That suggests actually that the way yields are acting is very, very irrational, and maybe in some ways the way equities are acting is very irrational, given that there's still no inflation to speak of. So if inflation data keeps coming in weak, and again, going back to this stronger dollar potential, I don't see why you couldn't see yields lower. You don't have any kind of real reason for yields to rise unless you have inflation and growth skyrocket, not just in the United States, but in overseas markets. You had this argument all along that treasuries are cheaper on a relative basis than a lot of the European yields. Unless Europe suddenly goes to some kind of resurgence in economic growth, it's hard to see how those yields rise, and if those yields rise, what that then means for treasuries.
Okay, so I'm looking at this move that we have in the dollar, and I understand your argument how you're basically importing deflation with a strong currency. How does the Fed, while they're ending QE, the taper ends, how does the Fed drive the dollar down under those circumstances? Could they possibly institute another QE program because of deflationary pressures down the road?
Yeah, it's an interesting question. I've been making a point on these presentations I've been doing around the country and these award-winning papers I co-authored that saying that I find it hard to believe that the Fed is going to do another round of QE, because if they do, they'll basically be admitting that the U.S. has turned Japanese. But of course, they could do a variation of QE and just call it something else, much like they called twist before QE3. So it seems like that's one way to possibly do it. But yeah, I keep going back to this issue that the Fed really can't fight, which is the structural reasons for deflation and the structural reasons for why you're going to have yields probably be lower on average than what people have been used to the last 2-3 decades. What that means for currencies is that, yeah, you're going to have these pulses of strength, but then ultimately it's going to be this battle between central banks for who can depreciate the fastest and avoid further deflationary pressure. We're in a no-win situation, I think, for a lot of developed markets. After all these trillions of dollars, they don't have the inflation that all the central banks are hoping for. It seems the only way that they can get it is by depreciating their currency. But if everyone's doing it at the same time, then we don't really get anywhere.
Okay, so perhaps the only thing that could take the dollar back down is Draghi over-promising and not delivering. Is that a possibility here?
Yeah, and I think that's a very, very real risk. Is that I think Draghi, as much as he's very strong in rhetoric, the actions have not really been as strong as the Federal Reserve. It seems like they tend to overpromise, underdeliver on that end. And we're also at this kind of dangerous point where if he's done negative rates for deposit rates and European banks have been crushed. I don't see how much more can be done. I mean, you're going to go to -1%, -2% on deposit rates? At what point do we start questioning the effectiveness of the ECB and if the tools are simply not working?
So what's a guy to do in an environment like this, Mike? I have to give you kudos. About 4 months ago, you were still long high beta stuff, and it worked till it stopped working, but it was a great position. How are you positioned at Pension Partners in this type of environment? And it seems to me VIX is bottoming here, and things are starting to get wilder. The adults are back from the Hamptons. What are you looking for this September, and how are you looking to take advantage of it?
Well, I think the key thing to really look for is a shift in the conditions that have done nothing but favor really buy and hold investors, and the mulling of risk management. I mean, really ever since QE3 began, there's been no need for risk management. There's been this belief that the S&P 500 is the new money market and that there's no more fear of declines. And I see a lot of...
Everyone's a genius.
Right, everyone's a genius in a bull market, right? And, I always say this in presentations, what separates the men from the boys in this business is not managing return, it's managing risk. And I think a lot of people have forgotten that risk still matters. There's a lot of ways to make money when it comes to investing. Perhaps the best way is to avoid big losses. Now, we've been in this environment where people have forgotten what a big loss is. If you're going to have this questioning of European Central Bank effectiveness and you're going to have the end of QE, I mean, what I'm looking for really is just the market starting to pay attention to risk again. If you get that, then that means volatility comes back, not just in equities, but in currencies, obviously. That allows those that are really actively and tactically trading the opportunity to really get better types of results and perhaps more stark results from those trades that they do. And that means that, we have to watch, I think, treasuries, we have to watch utilities, we have to watch those areas which tend to show the whites of the eyes of volatility. Yes, yields are rising today, but they've risen and then ultimately fallen all throughout 2014. If that dynamic continues, again, it is mind-boggling to me, this disconnect between treasuries and equities. It is undeniable. Treasuries are pricing in deflation. Equities are not. One of them is going to be wrong.
Or both right at different times. All right.
Exactly right.
So
Exactly right.
basically, the risk parameters have increased. You see more yellow and red lights than you saw last time we were together. If we do get some type of market correction, you think it'll be confined to, we've had about 3 or 4% pullbacks, and that's about it. Do you think that this time we could exceed it and at least have a normal bull market correction of 10%?
Yeah, I mean, I would certainly hope so, especially given how severe these disconnects have been, and maybe even more than 10%. You can talk about this idea of yellow lights and red lights. We've had a lot of yellow and red lights. It's just that you have drivers that are going right past it, ignoring what those signals have been, and they've been safe. They've gotten away with it, just speeding through that traffic light. But I keep going back to the reason that those lights are yellow.
Michael, in the last 6 months.
There's been, ever since QE3 and the taper talk began, there have been a number of junctures where you could have had high volatility. They simply did not happen. I'm saying that based on purely quantitative research. Now, this has been a prolonged period where a lot of those risk signals have been ignored. And it's very tempting to say that, well, there's no risk anymore, those signals are broken. I completely disagree. We live in a small sample in time. This entire outlier period has been beyond abnormal. If you get back to some kind of normalcy, that means volatility comes back. That means that the risk-reward equation still means something. And that means that, this complacency we're seeing in all asset classes probably ends with a bang.
Okay, so my takeaway from Michael Guyad today is we're going to see some mean reversion in the weeks ahead.
I think for the next cycle, we're going to see mean reversion, and not necessarily mean reversion in prices, but mean reversion in strategy and mean reversion in the risk-return equation.
Thank you so much, Michael, for joining us again today. Hope you have a great fall. Let's get back together, and I concur. I've been in that camp for a while, and perhaps this is finally the time where the Isaac Newton gravity theory finally takes hold in the markets.
Let's just hope that the apple doesn't hit our head too hard.
Thank you, Michael. Great interview. Thank you, my friend.